Hi and Assalamualaikum to everyone. We want to present about two companies that listed on Bursa Malaysia and categorized under PN17 or GN3 due to financial distress. This company may be prone to engaging in fraudulent financial reporting driven by potential motive within its management. So, for the Parma Niaga Berhad listed under stock code 7081 on Bursa Malaysia, operates in the healthcare sector and is Malaysia's leading pharmaceutical company, specializing in manufacturing, logistics and distribution. It provides a wide range of products, including prescription drug and over-the-counter medicines. Despite its robust operation, the company is currently categorized under PN17, signaling financial distress due to operational challenges and rising costs in a volatile industry. So for the Dua Parma by Taj Berhad, which is listed under stock code 7148 on Bursa Malaysia, operates in the healthcare sector as a leading Malaysian pharmaceutical company, specializing in the manufacturing, research and commercialization or generic drugs and biosimilars. It aims to deliver innovative and accessible healthcare solutions. With a strong local and global presence, the company continues to support Malaysia's healthcare development and beyond. The financial analysis focused on Dua Parma by Taj Berhad and Parma Niaga Berhad using annual report from year 2021 to year 2023. Key ratios analyzed include profitability such as net profit margin, return on asset, return on equity, for the liquidity such as current ratio and quick ratio, and for the solvency such as debt to equity interest coverage. The 3-year trend analysis provide insight into performance and stability, while a comparison highlight differences in financial position and operational efficiency. So, for the profitability on Dua Parma by Taj Berhad, the trend analysis show the net profit margin decreased from 10.28% in year 2021 to 7.47% in year 2023, reflecting reduced efficiency in converting revenue to profit. And for the return on asset ROA followed a similar pattern, dropping from 5.91% in year 2021 to 4.1% in year 2023, indicating less effective use of assets to generate earnings. Return on equity ROE improved in year 2022 for 2.9% but plummeted to 0.29% in year 2023, possibly due to declining net income and a growing equity base. For the liquidity on Dua Parma by Taj Berhad, the trend analysis show current ratio dropped significantly from 2.15% in year 2021 to 0.96% in year 2022 before recovering to 1.33% in year 2023. The quick ratio improved from 1.80% in year 2021 to 2.6% in year 2023, reflecting an increase in liquid assets relative to short-term liabilities. And for the cash ratio remain modest, improving slightly to 1.62% in year 2023. And for the intra-company comparison, Dua Parma demonstrated improving liquidity in 2023, showing better short-term financial health compared to Parma Niaga Berhad. Lastly, for the solvency Dua Parma by Taj Berhad, the trend analysis showed debt to equity ratio increased slightly from 0.87% in year 2021 to 0.96% in year 2023, reflecting a manageable reliance on debt. For the debt to asset ratio remained consistent around 0.46% in year 2021 to year 2022 before increasing to 0.96% in year 2023, indicating rising debt level. For the intra-company comparison, Dua Parma solvency ratio suggests conservative financial management and lower financial risk compared to Parma Niaga Berhad. So let's catch on Parma Niaga Berhad. For the trend analysis, for the net profit margin peaked at 17.23% in year 2022 but fell drastically to 2.31% in year 2023, indicating a significant drop in revenue efficiency. For the ROA, followed a similar trajectory, peaking at 29.68% in year 2022 before declining to 4.19% in year 2023, reflecting inconsistent asset utilization. And for the ROE declined sharply in year 2023 to 4.19%, suggesting reduced return for shareholders. For the intra-company comparison, Parma Niaga Berhad, inconsistent profitability contrasts with the duo Parma Bajaj Berhad steadier performance, highlighting operational inefficiencies and a lack of cost control. For the liquidity on Parma Niaga Berhad, the trend analysis show current ratio dropped from 1.1% in year 2021 to 0.55% in year 2023, indicating increasing difficulty in covering short-term obligation. For the quick ratio remained consistently low and approximately 0.23% to 0.26%, signaling limited liquid asset. For the ratio showed slight improvement in year 2023 for 6.3% but remained insufficient for immediate obligation. For the intra-company comparison, Parma Niaga's declining liquidity ratio reflects a significant financial stress compared to duo Parma Bajaj Berhad, which has shown a recovery in year 2023. For the last one is solvency. The trend analysis show debt to equity ratio increased from 3.8% in year 2021 to 8.99% in year 2022, before slightly improving to 7.99% in year 2023. For debt to asset ratio rose steadily from 0.79% in year 2021 to 1.14% in year 2023, signaling increased reliance on debt. The intra-company comparison, Parma Niaga's Berhad higher leverage and rising financial risk reflect weaker solvency compared to duo Parma Bajaj Berhad, which has maintained more stable ratios.
For potential indicators of fraudulent financial reporting, Parma Niaga Berhad is identified as a red flag. First, it is because of unusual trends in profitability ratios. The company's profitability surged significantly in 1 year before experiencing a sharp decline. This pattern suggests potential earnings manipulation, where revenue may have been overstated in the profitable year or expenses deferred to later periods. A sudden profitability collapse could indicate hidden financial risks that were not previously reported. Next, declining liquidity ratios. The current ratio has dropped significantly, indicating deteriorating financial health and a possible inability to meet short-term liabilities. The quick ratio spike suggests either inventory misstatement or reclassification of assets, possibly to present a stronger liquidity position than reality. These trends hint at potential window dressing, where financial statements are adjusted to appear more favorable. Third point is extreme changes in debt ratios. The company has experienced sudden changes in debt to equity and debt to asset ratios, raising concerns about hidden liabilities. Such fluctuations suggest possible off-balance sheet financing, meaning debts may be structured in a way to avoid disclosure. A drastic reduction in debt ratios could indicate debt restructuring, but if unexplained, it may also point to misclassification of financial obligations. Last point, possible fraudulent practice. Earnings management deliberately inflating revenue in one period to show higher profitability. Expense deferral, postponing expenses to artificially boost earnings in a specific year. Asset overstatement, misclassifying assets or inflating their values to enhance financial position. Liability understatement, hiding or misrepresenting debts to make the company appear less risky. For duo Pharma Biotech Berhad, it shows moderate financial risk but some areas of concern. For the profitability ratios fluctuate moderately, suggesting normal business cycles rather than outright fraud. However, any unexplained growth or decline should still be analyzed for possible manipulation. Next, liquidity ratios. Liquidity remains relatively stable, but minor concerns exist regarding financial flexibility. Any sharp movements in cash reserve or current assets should be monitored for potential short-term liquidity risk. And for the debt ratio shows variations with no extreme spikes. However, any sudden increase in leverage should be examined, as they may indicate hidden liabilities or aggressive financing strategies. In these areas, both of the company need to monitor. First, revenue recognition policies, that is, ensure that revenues are reported correctly and not prematurely recognized. Next is expense timing, that means check whether expenses are being fairly recorded rather than delayed to manipulate profits. Debt and cash flow management. Look for signs of financial stress that might lead to misrepresentation of financial data. Pharmaniaga Berhad shows significant red flags, suggesting possible financial misrepresentation and requires deeper investigation. Key areas to scrutinize include revenue recognition, asset valuation, and liability reporting. No pharma biotech Berhad appears financially stable but should still be monitored for any anomalies.
For disclosure index, first operating segments, Mfrs 8, Pharmaniaga identifies segments through CODM reports but provide limited disclosure on profit or loss derivation, needing improvement for stakeholder clarity. Google Pharma aligns segments with CODM structure and provides detailed, fully compliant disclosures on segment performance and reconciliation. Next, foreign operation, Mfrs 121, Pharmaniaga remeasures monetary items using current rates and non-monetary items with historical rates but lacks detailed disclosures on foreign exchange impacts. Google Pharma ensures proper exchange rate usage for monetary items and offers basic but improvable disclosures on financial impact. The last one, related party disclosure, Mfrs 124. Pharmaniaga reports related party transaction at agreed terms but lacks comprehensive details on pricing and balance. Google Pharma provides fully compliant detailed disclosures, enhancing transparency and trust. In summary, Pharmaniaga needs to improve its disclosure, while Pharma excels with transparent reporting. Thank you.